In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
Two Fed governors break ranks with Powell. Nancy Tengler of Laffer Tengler Investments joins us today. Okay, Nancy, the Fed left rates unchanged as expected, but Christopher Waller and Michelle Bowman dissented, voting to cut rates by a quarter point today. That's the first time in more than 3 decades that two Board of Governor members formally dissented in the vote. What do you make of that?
Well, Lisa, I actually think it's kind of refreshing. The groupthink at the Fed has always bothered me, where it's a unanimous vote every meeting. I think what it's setting up is a debate for the future, and maybe around Jackson Hole, but certainly. There are many, at least in my position as investors, professional investors, that think the Fed should begin cutting. They are laser focused on tariffs. That isn't even really their mandate, though they're tying it to inflation. But we think that there's a number of reasons that the Fed should be thinking about cutting.
So talk about those reasons, and also talk about what struck you in the Fed policy statement today.
Yeah, well, I think there was one noteworthy statement in the Fed policy statement, and that was that the economy is expanding and now they're replaced it with it's moderating, and I think that's a fair comment. I mean, we have seen deceleration. If you looked at today's GDP numbers, what you saw was imports. Really were a lack of imports. So fewer imports than we saw in the first half when the pull through was happening, or the pull forward was happening. So it contributed 5 percentage points to GDP. Inventory subtracted some, but generally speaking, the only sort of bright spot in that report was the consumer, which is moderating their spending, but they were 1 percentage points of the GDP number, and they're holding up the economy still. And I think what we'll start to see in the second half after the passage of the OBBA is that you'll see companies begin spending, and the consumer hopefully will get rejuvenated. But there are some cracks showing up in the labor market, so we're watching that pretty closely.
We saw President Trump today again attack the Fed for not lowering rates. His criticism has been relentless. Are we seeing some of that criticism start to seep in to the Fed in its decision making, whether it's through Waller and Bowman or otherwise?
Yeah, I think he's changed the narrative. Listen, I'm 100% behind having an independent Fed. And we could argue all day long about, has the Fed been independent or not? There are many who think they've been political to a great extent. And we're a far cry from when Lyndon Johnson picked up his Fed chairman and pushed him up against the wall with physical force. So I wish the president would focus on other things, but this is how he does things. And so, yeah, I think at the margin, it's shifted the focus, and it has brought to the fore more and more people willing to say it's time to cut. And last thing I'll say, Lisa, is this Fed's been 100% wrong at every turning point. So there is a credibility issue. And there were tariffs in Trump 1.0 when he appointed Chairman Powell. He raised rates then in anticipation of inflation, gave us the 2018 bear market, and now he's waiting perhaps too long to cut.
So we get the latest inflation and jobs data this week with the Personal Consumption Expenditures Price Index and, of course, Friday's non-farm payrolls report. What are you expecting, and how much do you think it will influence Fed policy?
Well, it's hard to know how it's going to influence Fed policy because I haven't yet had a chance to look at the dot plot. Not that it really means all that much, but I think what we're seeing is a marginal shift to more easy monetary policy. But I think that the PCE number is expected to come in around 0.3%. It could be a tad hotter. I don't think that would be devastating. Remember, in the 90s, we had inflation of about 3% that coexisted with higher interest rates and robust stock prices. So I think for stock investors, monetary policy at these levels doesn't matter all that much. But I do think that the job market is starting to show a little bit of stress. We saw that in the JOLT numbers. The quits rate is way down and the hiring rate is way down, which is usually an indication that people are unwilling to make changes in their job because they're worried about finding a new one. And then we saw that layoff rate had gone up pretty dramatically over the last couple of months in the jolt. So I think we need to watch that. And that is part of the Fed's mandate. So I hope they're paying close attention. That would argue for a cut.